All right. Hello, everybody. My name is VP, and today we have Maria Rosero with us, and she's a practicing CPA for 20 years, and she's doing taxes for 20 years. She lives in Orange County, and real estate is her specialty. And she also does our taxes. She's been doing our taxes for multiple years for all of our syndications. Uh, so she's very meticulous, very detail oriented. So I'm really, really happy to have Maria on our team. So thank you, Maria, for joining us.
Thank you for having me.
Good, good. So Maria, what we want to do today is we want to pick your brain on like real estate taxes in general. So we're going to start with simple stuff and maybe get into a little bit more detail about real estate, its tax implication, investments, all of that stuff. And yeah, why don't we get started with that? So let me begin with a simple question, right? Let's say I bought a house at 500K. I know you can't find a house 500K in LA anywhere, but let's say you manage somehow. And it has appreciated over the years, and now it's like $1 million. And I can afford a larger house now, so I moved out to a larger house. Now, what should I do? Like the first question I have is, should I sell it or should I rent it out? Right. So let's consider the first possibility, which is, what if I sell the house? What would be the tax implications? Am I going to have to pay a lot of tax, whatever, all these capital gains that I've accumulated over the years? What will happen?
Okay, so let's assume that you've had that house for over a year. And so your capital gains tax could potentially be the 15 normally to up to 20% on that home gain. So the holding period is important. The other thing that you can consider is the 121 exclusion, which it basically is known as a home gain exclusion. So basically for a single person, you can exclude $250,000 of that gain from your taxable income. Now, if you're married, filing joint, it's $500,000 that you get to exclude. So it also depends on, do you guys qualify? So to qualify, it's like the ownership test and the usage test. And only one of you, if husband and wife, has to qualify for being the owners of the property. But both of you should be using the property as your primary residence for at least 2 years out of the 5 years since you sold the property. So that's something that a lot of people can take advantage of nowadays. Now, the tax difference, if there's like a gain in addition to what you were able to exclude, then you would factor in the capital gains tax.
Okay. So you're saying I should be living there for 2 years in the last 5 years.
Correct.
Right?
Yeah.
So that means if let's say I'm living there continuously for like last 5-6 years, then as soon as I move out, I have 3 years to sell it in order to actually take a benefit of this exclusion, correct?
Right. So, but yeah, as long as those 2 years, it was your primary residence for those 2 years at least. Correct?
Okay, primary residence. And you said both spouses must be living there, right?
No, so yes, I'm sorry. Yeah, both spouses must have lived there for the 2 years at least.
Okay.
And they don't have to be consecutive years. It could be on and off as long as it's 2 years total.
As long as it's 2 years, okay.
Right.
Yeah, this is very useful because then what that means is that selling becomes a very viable option because then I can avoid capital gains tax on all this, $500,000 of gain or whatever the gain that's computed. That's amazing. But let's also consider the other side, right? Like let's say, but I don't want to sell right now, and I want to rent that house. Then what would we do? What would be the tax implications on a rental?
Yeah, so that's where you can benefit from those tax benefits of the rental deductions, right? So like you can offset the rental income you're collecting via depreciation expense, if the property is mortgaged or mortgage interest or other operating expenses for that rental, you can offset. Now there's limitations. So the IRS sees all rental properties as passive properties. So there's limits. So you cannot deduct any passive losses unless you have passive income. So, but even then it's okay because that loss, let's say you had a loss in 1 year, you get to carry it over to the next year. So it's not lost, it's just accumulated loss. Now, like if there's taxpayers that have, their adjusted gross income, their gross income under $100,000, then they can fully utilize the rental loss in that year. And there's phase outs. We won't get into detail of the phase outs, but once it hits your AGI hits $150,000, then there's limitations to how much you can deduct. But that's also something to keep in mind of.
Okay. So why don't we do this? Like, I think a lot of my listeners might not understand what a depreciation is. So if you can just quickly explain what a depreciation is to our listeners, that'll be helpful.
Yeah, so let's say your house is worth, let's say, so once it becomes a rental, you basically, you can start deducting the depreciation, I'll tell you what it is now, based on like the original cost basis or the fair market value of the property. It's the lesser of, right? And so you're able to recover that money that you paid for the house over for residential rentals 27.5 years. So let's say the house is worth 100,000, you divide that by 27.5 basically to keep it simple. And then you have that deduction every year until you've written up your complete cost basis on that property. That's what depreciation is. You can recover basically what you invested into the property over a period of time.
Okay. So it's like it's a fake loss, right? It's not a real loss, but you can still use it, sort of. Am I correct?
Correct. Correct.
Okay. Very interesting. So you can use this fake loss and you can then offset your income that you're getting from the property and essentially not pay tax that year.
Correct. Yes.
Okay.
A lot of times in the beginning, because you do have that depreciation, when you convert your property to a rental in the beginning years, you'll have losses. Especially if you have a mortgage on the property mainly. You'll have
maybe because of the income from the property hasn't increased that much yet.
Yes, and because that depreciation could be very beneficial depending on the cost of the property, also depending on what your mortgage interest rate is now, right? Because mortgages are higher, so then that you can deduct that against your rental income. So that kind of starts creating these losses.
Okay, I understand. Okay, but then one interesting thing is even though there is a loss, can I use these losses for other kind of income? For example, if I actually invest in stock and I had a large gain, can it offset that or it cannot offset that?
The rental losses, no. So the rental losses are their own little bucket. So your capital gain income, your interest income, they're considered investment income. So they're in a separate bucket. You can just deduct, you can offset those gains by capital losses.
Okay.
Those are passive activity losses, so that's like their different bucket. So we offset those losses by other passive income, whether it be from, your partnership investments, from those sort of investments, really.
Okay. Oh, those kind of investments only. I understand. And also, I think, is it really tax avoidance, or does the IRS captures this tax back at some point of time?
So no, it's not tax avoidance. It's you're deferring. It's tax deferral, basically.
Tax deferral. Okay.
Yeah, it's all basically deferred because once you sell the property, like the depreciation you took on it kind of gets added back in a sense. So if let's say you fully depreciated the property, you sell it, well, now you have no cost basis left because you utilized it all. So then your gain kind of gets factored in there. So it's all kind of a deferral mostly.
Okay, it's a deferral mostly. I see. Okay, that's interesting. So it's not, you can't just, you're not avoiding the tax, but you're making sure that you're deferring it. So if you keep the property for 10 years, then you are essentially deferring for 10 years.
Correct. Yeah, I mean, you definitely, so it's just time value of money, basically. You
Time
want to
value
take,
of money.
losses now versus later. So,
but is the tax rate the same then when it gets, I'd say I'm selling the property after 10 years. What is the tax rate is going to get used then for on this recaptured depreciation?
Yeah, so it depends. So basically, it's could be up to 25% on the depreciation you've utilized, depending on, let's say a cost segregation, right, where you're able to piece out like certain like your cabinets, your carpeting, that all takes less time to depreciate. So let's say you did a cost segregation and you did that into those assets. So now that recapture gets recaptured, the recapture rate is based on what your tax rate is that year that you sell. So it could be as
Oh,
high as 37%, it could be as low as 5%. It just depends what your tax rates are.
okay.
But the depreciation, the basic depreciation straight line, then that's just recapture at your 25, 28%.
25 to 28%. Okay. Okay. So there is two different rates. One is for the straight line depreciation and other is for the other kinds of capital expenditure that you've done.
Your other appliances, your other improvements that
Other,
you've done to the property. It all
right,
depends.
right. And what is this cost segregation? If you can just quickly tell us, like, what is cost segregation?
Yeah, so cost segregation is basically when you hire, a lot of the firms offer this, they're like engineers and they go and scope out your property. They piece out certain things that, traditionally when you depreciate a residential property, it's automatically 27 and a half years. Right? And your land is kind of not depreciated. So the portion of the land value just doesn't get depreciated. But cost segregation studies, they scope out the property, they pull out things that could be 5 years, like your cabinets, your countertops, your electricity switch, that's all stays 27 and a half years, but there's things that they can piece out that you can basically have bonus depreciation, which is additional first year depreciation. Currently it's 60%. Hopefully that changes back to 100%. So you're able to take more advantage of higher depreciation deductions through cost segregations.
Okay, okay. So that's
And then,
another way for investors to save taxes because of real estate. Okay. Cost segregation is another tool that they have.
right.
Okay.
And there's limitations, honestly, because also for limited, it depends what type of investor you are.
Okay.
So, but it's still a good option because you can still hold on to that accumulated depreciation that you weren't able to take. So,
Okay. Okay. That's perfect. Thank you. All right. Let's move on with this now. So another twist in the whole story is that. So I said that okay, I moved out of a house and then I had a choice of selling it versus converting into rental. Right now, in both of, let's say the first case where I'm selling it, right? I heard that um, there's different tax implications even in those cases for different incomes, right? So if my income is, let's say, more than 400K or something, what happens? Like, is the tax implication different?
yes, definitely. So, for example, for the capital gains rate, long-term capital gains rate, it shifts from 15 to 20%.
At what income level?
So the income level for married filing jointly is above 583,000, close to that amount.
583,000. Okay.
Anything above that gets taxed at a different rate, 20%. It could be a combined rate, but once it hits that amount, it's 20%. And then you also have the net investment income tax,
Uh-huh.
which is a 3.8% tax assessed on your investment income. And
Okay.
your capital gains fall into the investment income category, and that phase out's a lot smaller. It's $250,000 for, let's say, married filing jointly. So
Okay.
once you hit that threshold, then all your net investment income will be possibly taxed at 3.8%. So there's different calculations that go into play, but yeah, you have to consider that as well, which is a much smaller threshold than your over 500,000
Okay.
taxable
Okay.
income.
So yeah, for higher income levels, there are different tax implications, and in the higher income level you are, the higher the tax will be. In short.
Yes, unfortunately, yes, yes. That's what
Right, right, right. And so let's say, and what about rentals? Like, is there any, if I have a rental, if I convert into rental, then is my income level matter there or no, not really?
No. So for rental properties, like I said, they're deemed passive for through IRS default rules. So your income level doesn't depend on it, except for like if you do have a rental that has a loss,
Mhm.
and your AGI matters. So it's hard to get to it nowadays. But like if your AGI is below 100,000, like your gross income, let's just say it could be close to your taxable income, then it starts to, you could deduct up to $25,000 of those losses. But once
Mhm.
your income exceeds the $150,000, you're just in the same ballpark, basically. You don't get any additional deductions.
Okay, any additional deductions? Okay. Okay, so it's pretty much same for a rental property. Okay.
Yeah.
That's great. So now let's move on from this simpler things to more complex things. Like, so for example, let's say I am a limited partner in a syndication. What kind of tax benefits can I get as a limited partner?
Okay, so for starters, pass-through partnerships are pass-through entities, meaning like their profits and losses get reported to you via K1. As far as the deductions or benefits, they could be significant because again, if you have depreciation deductions, then they could be greater with the cost segregation. You have your mortgage interest. There's a 1031 exchange that could come into play, cash out refinances, and also even though you might have those limitations as a limited partner for passive losses that we talked about, they still get carried over. So you don't lose them. Eventually you'll utilize them so they don't get lost. But let's say if you're a passive investment investor at limited and you have other income from other sources, passive income, you're able to offset those losses. So it just depends on what type of other investments you have as a limited partner. But also the distributions coming out from the partnership are generally tax-free. So you don't pay money on those cash flow distributions in most instances.
And why is that? Because why are they tax-free? Because of depreciation or something else?
Yeah, they're tax-free because each year the partnership will give you that K1 and the profits and losses are part of that already. So that's why each year you're already reporting the activities of the partnership. So the distributions don't come into really play because they could have been taxable already.
Okay.
So yeah, so it's not in that you don't get the K1 plus you don't pay tax on the distributions. It's just your income is just determined basically on the K1 activity. That's
Oh,
your
okay. Okay. So then I guess you're saying that they're pretty much tax-free, the income. That's pretty good. And then what happens if so if I'm that means all these benefits that are in rental properties sort of also exist in syndication for a limited partner. Is that what you're essentially saying?
pretty much, yes. Yeah.
Pretty much. Okay.
You can do the same. Yeah, you don't need a syndication to do like the 1031 exchange, let's say, or the cost segregation. It just takes more effort, right, on your part versus in a syndication where it's all kind of done for you. So
Right. So in syndication, you invest money, you get the
yeah,
same tax benefits, but somebody else does the work.
yeah,
Or you don't have to manage the rental actively.
yeah. It takes off that work from you.
Right. That's perfect. So let's consider this case of like so our syndication has some investors from other states, right? Texas, Virginia, but we do buy properties in California. So then, so if somebody lives in Texas and they're investing in a property in California, then do they need to pay taxes in California? How does that work?
Yeah, so they definitely need to file a California tax return because California, it's safe to say, will tax anyone that has ties to California. So now, since your properties are in California, and even though your investors are non-residents, they'll still get a California K1. And so that Franchise Tax Board will definitely be expecting a tax return. And so let's say in the beginning your K1 shows losses. They might not care in the beginning, right? But let's say later on your K1s show profits, then that FTB will be looking at those a little closer. So where is this return then? So yeah, it's always better to file and be compliant than for wait to notice it, for them to issue notices and then be scrambling around about why you didn't file. But yeah, California and a lot of states, if your property is in that state, they'll expect a return as well.
Okay, so I see. Okay, so what if you are living in some other state and your property is in some other state, then you might have to file tax return in that state as well. Yeah.
Yes,
Okay.
correct. Yeah, so they try to eliminate double taxation. We're not paying the same tax in both states,
Yeah.
but the filing requirement is still there.
Yeah, but with Texas, there's no taxes, right? So then in California, there are taxes. So then people in Texas who are investing in California properties have to still pay taxes.
Yes, yes. A lot of people don't know that, and they don't think that they're going to have to file, and then they're surprised when they do.
Right. Makes sense. Makes sense. Okay. All right. So then let's talk about a little bit more advanced case of like, what's known as a real estate investment trusts or REITs, right? And especially the big ones that are traded on stock market, right? So then, because I have a choice as a passive investor to invest in these syndications versus in REITs, right? So then is the tax statement different for these stock traded REITs versus the syndications?
Yeah, definitely. So for syndication, we talked about you getting a K1 with your profits and losses reported. A REIT is kind of like a stock, right? You get dividends, so you only get profits. You don't get allocate any losses from the REIT. It's only profits, and it's taxed at capital gains rates. The one benefit of a REIT is that they do qualify because they're basically real estate trusts, right? So they qualify for this qualified business income deduction, which is 20% of the amount that passed through to the investors. So that's an automatic taxable deduction that you get from a REIT. That's the major differences, but you don't have your syndication, depreciation expense, or other expenses that flow down, any losses that flow down to you, basically.
Okay, okay. But then I heard that that thing is also going to go away, right? The REIT advantage that you have, the
Yeah,
pass-through tax.
the qualified business income deduction, yes. So it's set to expire next year.
Okay,
So
so that's not permanent. Okay,
no,
I
it's
see.
not. So we'll see if there's any changes made to it because it's been such a great deduction for a lot of taxpayers. But yeah, that's set to expire.
Okay, all right, good to know that. Um, all right, and now let's go even more advanced. Like, what happens if I want to invest in one of these vehicles, some of these vehicles, or even rental properties, and I don't have cash saved with me, but I have some money in my IRA. Now, can I take my IRA money and invest in real estate?
So you personally can't. The IRA can invest in real estate, but there's compliance issues, right? So the IRA can any money going in and out through the IRA has to be funds from the IRA. So personally, you can't be taking out monies and investing to the partnership on behalf of the IRA. It all has to go through the IRA to be in compliance, and the IRA also will get like the K1 and reported. And it's important that the K1 is provided to the custodian of the IRA to be in compliance.
Oh, I see.
Yeah, to make sure there's no tax filing requirements on that IRA. But yeah, you all the funds have to be moved from the IRA itself. They should be IRA funds, not
Okay, so
yours.
you're saying that the investment happens from the IRA, and then the distributions that come out of syndication will also go back to IRA, right?
Correct. Yeah.
Um, and what about tax implication? Like the tax is the same, or is there a different way? Because IRA doesn't usually IRA doesn't pay any tax, right?
Yeah, they don't. They don't. So let's say the fund you invested in, the real estate fund that you invested in, they have a mortgage tied to the property.
Mhm.
So now we have a situation called a debt financed property. And that's where it impacts IRAs. So the IRA might have to, like at that point, there's different disclosures that get reported in like K1 for the IRA. So there is the tax exposure to the unrelated business income tax that the IRA
Okay.
could be exposed to. So depending on the business income of the partnership.
Mhm.
So let's say the IRA has over $1,000 of unrelated business income because of that finance property,
Uh,
then the custodian will probably have to file, well, let's say they will have to file a tax return. It's a Form 990T, and
okay.
at that point they'll figure out any taxes due for that IRA.
Oh, interesting, interesting.
Yeah.
So then, so they have to file taxes on your behalf almost because of your real estate investment. I see.
Correct. Yeah, the custodian. Yeah, the custodian that's
And I'm
managing
sure
that.
they'll pass on that cost to, I guess, not to us, but to that IRA.
Yeah,
Yeah, to whatever the money left in IRA or whatever distributions that are coming in there. Yeah.
correct. Yeah.
Okay. Okay. So there's actually additional taxes when you invest through IRA.
Yeah, there
Uh,
could be, yeah, because it's a tax exempt, right? But because of the debt finance property, it could create a taxable
okay. So
event.
if the property is bought all cash, then this wouldn't be an issue.
Correct. It wouldn't be an issue.
This wouldn't be an issue. Okay. All right. Got it. And about a few minutes ago, you said something like you said 1031 exchange, right? Can you explain us like what is 1031 exchange and how does that? Yeah.
Yeah, so the 1031, yeah, that's very famous. It was the very first thing that stuck to me when I started working in public accounting. I had to do that one as a junior. It was scary, but
Mhm.
it's very common in real estate. So what it is basically a swap. You're basically swapping one real estate investment property for another one with a higher value, though.
Oh,
And
higher value.
it has to be
Interesting.
higher value, yes.
Okay.
And that allows the gain to be deferred. So
Okay.
whatever gain you made when you sold that first property, it could be deferred if you meet all the qualifications for the 1031 exchange. And
Okay.
that's important to note. The gain is just deferred. It's not eliminated. That creates a lot of confusion. A lot of times people forget that they did a 1031 exchange and they don't recall that once they sell the second property, they do have to pick up that deferral basically. So that's important to note. And just basic qualifications to be met, just some not inclusive, are basically you have to reinvest the net proceeds from that sale back into your new property. There's timing requirements you have to meet, like 45 days to identify a replacement property.
Oh, wow.
Yeah, and
That's a pressure, huh?
it's a lot of pressure, and there's like 180 days for you to close on the property as well. So that and the money that you receive from the first property has to go into an escrow that no one from the partnership can touch the money. It has to be very separated out from an unrelated business third party, let's say. So those are the qualifications. And I think this is the one thing that I think everyone should contact their tax advisors before engaging, if they're thinking about 1031 exchange, because it could be a lot of confusion, a lot of requirements that didn't get fulfilled that could definitely not qualify it. And to minimize any surprises, this is the one area that you definitely want to consult your tax
So
advisor.
do it before you start 1031 exchange instead of after going to a tax advisor after you start 1031 exchange.
Yes, yeah. Just when you start thinking about it, get with your tax advisor. That's the biggest advice that I have. And that's true for like a lot of the tax situations. You want to talk to a tax advisor
Okay.
before you make any decisions, because it's hard to undo things once they're done, right?
Undo things. Okay.
Yeah.
And I would even go further and say that in even in this cases, right, just don't listen to us, right? Your situation could be different. So go to your tax person and make sure that you show them all numbers that you have, and then they'll tell you they'll give the right advice, right? Yeah.
Yeah. Every situation is different. A lot of times people talk to their friends and like my friend did it, or I know my coworker did it. It's everyone's situation is different. So you want to, make sure you talk to someone because your situation may be different. Even from, you're right. From what I'm seeing, could be different than your situation.
Yeah. Talk to a qualified tax person. Yeah.
Yes, definitely.
Absolutely. Yeah. Uh, yeah, I mean this was great information, I think, for our listeners. So Maria, let's say if they, they like what you're saying and they want to contact you, like, how should they contact you? You're in Orange County here, right? So then, yeah, how can they contact you?
Yeah, first off, yes. So I operate remotely. So any meetings, virtual meetings, doesn't matter the location of them. Reachable at any point. My website's in the works right now, but they can stream an email to Maria at mrosero, ROSERO, CPA.com. My phone number is 627-440-2037. So definitely, I am pretty responsive. So any questions, they may reach out.
Yeah, I think, first email, right? That's the best idea. Maria at mroserocpa.com.
Correct.
Yeah, that's perfect. Thank you very much for spending time with us, and uh, I'll talk to you later about our usual stuff, like for the next syndication and all that stuff. Thank you again.
Yeah, awesome. Thank you for having me again. Thank you. I appreciate it. It was fun.